So welcome everybody to another webinar with my two good friends, Grant Williams and Ronni Stoeferle. You know, they're not just good friends, they're also advisors to MAM. I'm incredibly pleased to have them as advisors. It's difficult for them to perform their role in the way that they normally would by meeting up around the world and in Switzerland, of course, because Grant is still in Cayman and Ronni is in Austria and I'm in Switzerland. So hopefully next year will be better, but time will tell. We don't know yet. We thought that this time we'd start to talk about something that is on our minds all the time, and we were talking about, and that's obviously debt and also inflation, which is linked to debt. If you just give a global picture, if you think about debt, global debt was 1971, $5 trillion, around $5 trillion. That was in 1971. In 2000, it was $80 trillion. And today, it's $280 trillion. So in the last 20 years, 200 trillion out of 280 trillion throughout history has been created. And we can see where it's going. You know, it's clearly, this is now, we are when it comes to debt creation, we are in the exponential phase, and we are in the super exponential or even explosive phase now. And you know, the debts at these levels can only lead to one thing. Gentlemen, both Grant and Ronni have have written about cry wolf. Cry wolf is when when somebody cries wolf all the time, which means he's calling out for something to happen, or that the wolf is coming. And the wolf never comes because the wolf isn't there. He's just fibbing. And then when the real wolf comes, nobody believes him. So that's the cry wolf story. And I've been crying wolf for many years about the problems in the world and the debt problems. They haven't happened yet. So and a few people listen, but most people don't listen or protect themselves. Ronni, you have written about this recently in an excellent report from In Gold We Trust. And so maybe you give us your idea about what this actually means in relation to debt and inflation.
Thanks, Egon, and hi to everybody, actually all around the globe again. We've got participants from every continent, and it's a real pleasure. So thanks for joining us. We just published a paper called "The Boy Who Cried Wolf," where we basically said that after a kind of deflationary or disinflationary paradigm, we're now seeing a shift. And I think 2020 is indeed the year when many taboos have been broken. We're seeing that when it comes to balanced budgets, for example, nobody cares anymore. And that's, by the way, another great presentation that Grant once did. Nobody cares. So I think, the budget hawks have all been silenced, and honestly, nobody really understands those incredible amounts anymore. Just to put it into perspective, what we've seen for Western European countries in stimulus actions just over the first 2 months of the COVID crisis, that's 30 times in today's money the Marshall Plan. Compared to 2008, the fiscal stimulus in Germany was 10 times bigger this year. In Japan, it was 9 times bigger, and in the US, 4 times bigger than in 2008, 2009. So now we're seeing really unprecedented monetary intervention, but also fiscal intervention. And I think this is really a very, very important thing to understand. And the fact that Janet Yellen will become the head of the Treasury, I think it's a very symbolic thing. We have to really understand that this flirt between monetary policy and fiscal policy, now basically in 2020 they got married. And if you know history, you will know that this has always been a very dangerous combination. Now, to be honest, we've been wrong on inflation for quite a while. We thought that consumer price inflation would happen earlier. We saw massive asset price inflation, but so far those government statistics don't really show any big surge in inflation. And from our point of view, this is changing now. First of all, we're seeing this move from financial QE to fiscal QE. We're seeing, I would say, very interesting theories like MMT that used to be really on the very left side of the spectrum. They're becoming mainstream theories. Just one thing, a very big institutional asset manager conference in Germany. Who is their main speaker in, I think in April? It's Stephanie Kelton. And she's probably the most important economist when it comes to MMT. Then we are seeing that financial markets are already discounting. So they're already seeing higher inflation rates. It's not a coincidence that tips are rising. It's not a coincidence that gold and silver are rising, that commodities are rising, that energy is rising, even uranium is rising now. So I think that financial markets already smell that inflation is around the corner. And let's face it, this is exactly what central bankers want. It's not a conspiracy or anything. They are very, very open. They're saying now we're going to a average inflation targeting. So as inflation numbers were undershooting for many years, now the Federal Reserve wants inflation numbers to overshoot. So if we go to 4 or 5%, there won't be any pressure to raise rates. So from my point of view, you know, inflation has been something that nobody really cared about. I see from, you know, interest coming in for our products and our research that it's more and more becoming a topic. And I just sense that once inflation is really starting, it will be very, very tough to stop it.
Yeah. No, well, Grant, you've written about, but your presentation, Cry Wolf, was one of your epic pieces, of course. And I recommend to everyone to search Cry Wolf Grant Williams on the internet and listen to that. That is a genius presentation. You know, maybe you can just in 2 words tell us what the wolf, what role he plays and how you see that in relation to gold today, and then talking about the debt situation, because you know that would be really interesting for the audience.
Sure. Yeah. So for those who haven't seen the presentation, the premise was basically that every ecosystem has an apex predator, which is what the wolf represents. And the financial system, that apex predator used to be gold, and the apex predator essentially keeps the natural economic order functioning properly. And when wolves died out in Northern America, there was a movement to reintroduce them to Yellowstone National Park back in the 90s, and this created all kinds of arguments, saying it was a terrible idea and that the wolves would kill all the deer and ruin everything. So it went backwards and forwards, and eventually the pro-wolf lobby, if there is such a thing, won, and these wolves were reintroduced into Yellowstone National Park. And what happened was extraordinary, you know, because of the effect that the wolves had on the ecosystem in terms of predators, prey that would move to avoid where the wolves ended up being. It allowed the trees and the plants to grow back, and that allowed mice and varmints, and that allowed birds to come back who hunted them. So it had this extraordinary effect on the ecosystem by reintroducing an apex predator. And the presentation basically explained this and then went through it vis-a-vis gold being the apex predator financial system. And the point I was trying to make in the presentation was that there's an awful lot of talk about a gold standard, and people will tell you that there's no way we're going to go back to a gold standard. It won't work. It can't work. It's just not something that's going to happen. And the point I was trying to make was that I agreed with that in terms of a gold standard was never going to be a decision that was made, you know what, we should really go back on the gold standard. Because what you're saying by going back on a gold standard through choice is that, you know what, we really need to put some spending restraints on ourselves. We really need to be much more fiscally responsible and not spend all this money, which, as anyone with any experience will understand, that is not what politicians are ever going to do. So what I laid out were the conditions that would make it absolutely imperative for the world to go back onto a gold standard, not as an idea, but as a solution to a specific set of problems. And those problems essentially were political unrest, social unrest, and then unrest in financial markets. And obviously, we've seen enormous political unrest over these last several years. We've seen plenty of signs of social unrest going back to really the Arab Spring, I guess, right after the financial crisis. But we're seeing social unrest in places that we really don't expect to see that kind of thing happening on the streets. The only thing missing was financial market unrest. And by that, I mean some kind of crash. And if you have those three conditions in place, then realistically speaking, with the amount of debt we have in the world, as Egon's pointed out, you have no choice but to go back to some kind of sound money system to anchor everything again while you clean up the mess. And gold is by far the most logical thing to use as the anchor to any new financial system, no matter how temporary. I didn't say this was a gold standard that would then endure. It may only last a number of years, but it'll be important if we have a reset. And if you've been paying attention, you'll have seen this phrase, the Great Reset, being bandied about by all kinds of people, starting with the WEF and then the IMF. And then we've seen politicians in all kinds of countries using the phrase, the Great Reset. Something
they all mean different things, don't they?
Well,
the reset.
Yeah, you say that, Egon, but I suspect the frequency with which the phrase the Great Reset is being used, along with another great phrase about build back better. This is a handy dandy slogan that, if you're paying attention, you've seen politicians in Canada, the US, Pakistan, India, all sorts of places using this phrase build back better. The UK as well have used it. So there is definitely talk at G7, G20 level, IMF level, whatever it may be. They understand the precariousness of the financial system. And I think they understand that a reset will be necessary. And I would contend that gold will play a very, very important part in that reset of the financial system.
Yeah. But, there's no question that we are on the way to inflation and hyperinflation. In my mind, Ronni said that, there's no sign of inflation, but that's a good warning in itself, as you said also. When there's no sign, it means that the risk is very high. And everybody says there's no sign of higher interest rates. That's another warning that higher interest rates are around the corner, in my view. We all talked about how money supply absolutely is growing exponentially. You take M1, for example. M1 in the US was $1.5 trillion in 2009. That's when the crisis was over, $1.5 trillion. And it was 4 trillion in March 2020. And now it's 6.5 trillion. It's just grown 2.5 trillion since March. So, and you look at the curve, it goes like that, and then straight up, absolutely straight up. That is the prelude, in my view, to hyperinflation. Sure, you've written about, Ronni, velocity of money, also in your last report, and everybody talks there's no velocity. Of course there isn't, but when the currencies collapse, which is, in my view, going to happen, then of course the velocity will change very, very quickly. Okay, so let's go on to our second point today, and that is a topic that I think everybody's interested in, because there is so much discussion now between Bitcoin and gold. We've all written about it in many ways, and of course today is a day when Bitcoin is actually up to over 23,000. So the Bitcoin investors are extremely happy, of course, and gold is behind there. Ronni, can you give us your take on Bitcoin and gold, where you see the advantage of the one against the other?
I think I don't like the fact that they're seen as competitors. And there's this drop gold campaign, and people on the gold side, they are most of the time they're against Bitcoin. I think they should be kind of working together, because the enemy is probably fiat money. And of course, I mean, gold has a track record of 5,000 years, and Bitcoin has a track record of 10 years, basically. So the risk reward clearly is different. we've got one fund where we combine physical gold 75% with 25% digital gold, which is Bitcoin. We use options because the volatility of Bitcoin is just remarkable, and you can use it. And I think, you know, now everybody, of course, is going bonkers when it goes to new price targets. I saw, who was it from Guggenheim, Scott Minerd, coming out with 400,000, and before that, yesterday, somebody with 100,000, whatever. So that's clearly a sign that it's massively overbought. However,
but, you know, you take Grant's old colleague and co-founder partner of Real Vision. You know, he's talking about 1 million based on stock to flow, etc. 1 million target. So clearly there are a lot of high targets around for Bitcoin, and you know, sometimes these become self-fulfilling, or do they?
Well, normally I think it's a sign that the market has been running a bit too hot, when basically every minute there's somebody coming out with a crazy price target. But from my point of view, I think this bull market in Bitcoin is completely different to the 2017 one. I think that Bitcoin kind of has grown up. We're really seeing that it's being adopted by financial market participants. We're seeing lots of interest from family offices, from wealth managers all over the globe. We saw that, you know, big names like Stan Druckenmiller, Paul Tudor Jones, they were talking about Bitcoin in a very positive way. We saw insurance companies like Mass Mutual. I think the company is around for more than 130 years. They were buying 100 million worth of Bitcoin, which is a very, very small allocation for them, of course. But I think we're really seeing that the market is becoming more professional with futures markets, with an option market. And now you really have the regulatory framework. So the regulators know in which box to put Bitcoin, while 3 years ago they said, what is it? You know, how shall we regulate it? So I think quite a lot of things turned for the positive. You know, from my point of view, I once said in a conversation that Grant and I had on Macrovision, I just wonder why there's so much criticism coming out from the gold space. I think that those people, or this one Satoshi Nakamoto who created Bitcoin, I think he really understood our monetary system, and he clearly understood gold, and he wanted to provide something similar, something perhaps a bit modern. So therefore, I think, you know, it's from an intellectual point of view, it's very, very interesting. And I have to say that I'm meeting super bright people from the industry. Is it extremely overvalued as at 23,000? I don't know. I just see lots of momentum. I see that there's really big money now flowing in. We saw this macro strategy, Michael Saylor, which from my point of view, you know, investing all of the cash in a company in something that volatile like Bitcoin, that's a pretty dangerous strategy. But I think that there's a place for Bitcoin, and at some point, I think it will be normal to have an allocation of 2, 3, 4%, whatever, in digital assets.
But isn't there a risk? And Grant, you talked about this also. You know, that to me, I see Bitcoin as binary. Yeah, I mean, it's either it could go to 1 million, maybe. I have no idea if that's a good target or not. Or it can go to 0 if central banks decide that their digital currencies are actually going to be the only digital currency that will be accepted, and they will stop competing digital currencies, which are one day, of course, if they become too big, they would do, because that's another currency which they haven't approved. What do you think, Grant, is going to happen with that?
Yeah, look, I think everybody wants everybody's opinion on Bitcoin at the moment, which I find interesting. Everybody wants to know what I think about Bitcoin. And as someone who's not a vocal Bitcoin supporter and a vocal Bitcoin detractor, I'm always fascinated why people want my opinion on it, frankly. But I'm very open-minded about it. I certainly am not in the camp that just writes it off as a complete waste of time. I think I understand what it's there to do, and I think it's a very elegant solution to the set of problems that it set out to try and work around. But we just don't know. I have a lot of questions about it that I'm actively looking to have answered. You know, if I can get satisfactory answers and get comfortable with it, I'd have no problem owning Bitcoin. But I do have this big question about whether it will be allowed to flourish once central banks have their own digital currencies, because they have a history of not allowing competition in that particular space, and quite rightly too. If you have a monopoly on issuing currency, why would you allow competition in there? So I do have big questions about it, and the only answer I've had so far is, oh no, they would never do that, or it won't be in their interest to do it. Well, I can assure you that it absolutely will be in their interest to ban it under certain conditions. And once you do that, it changes the whole dynamic. But I think we need to separate what Bitcoin was designed to do and what it is capable of with what's happening right now, because I think that's a wholly different phenomenon. I totally agree with Ronni. I think this bull running in Bitcoin is very different to that we saw in 2017. And a big reason for that is the adoption of cryptocurrencies by institutional investors. And let's face it, a lot of big names like the Tudor Jones of the world and the Druckenmillers of the world. But as I said, I promise you that Stan Druckenmiller and Paul Tudor Jones didn't tell you how much they liked Bitcoin because they planned on buying it the following week. I can absolutely promise you that. They already had their positions. I can also promise you that the Druckenmillers of the world and even the Michael Saylors of the world are not going to tell you that they're going to trim their Bitcoin positions. Michael Saylor is not going to tell you that he's going to switch some of his Bitcoin back into dollars because it's run too far. He's just not going to tell you that. But if he isn't doing that, that's a remarkably dangerous strategy to take. So we're in that moment now with Bitcoin where it's become a thing again, like it was in December 17. But between that day, that period 3 years ago and today, what we've seen is this extraordinary herding mentality, which has kind of taken into these, what my friend Peter Atwater calls investing flash mobs. There are people that dive into Tesla and do crazy things. That we saw it with Hertz, a company that's bankrupt and the equity triples, when anyone that's had any experience in financial markets knows it's worth precisely zero, but people are buying it for $6 because they see it moving. And Bitcoin, I think, is attracting a lot of that money right now. It's attracting an awful lot of hot capital flows. But we still have this situation where 95% of the Bitcoin is in existence is owned by 2% of the accounts. And that's a huge problem. No matter which way you cut it, that means Bitcoin can be pushed around, it can be manipulated, and it's in strong hands. So it could go significantly higher than this. But I don't think that's going to be based upon any kind of investment framework, a stock to flow model. It's not going to be that right now. Over time, Bitcoin, if it's allowed to flourish, if it's allowed to do what it's capable of, it could have an astronomical valuation. But right now, if you think this is 23,000 is one train station on a line that ends at $1 million, and you can just buy it and sit on the train and ride it, you're out of your mind. There will be 50, 60, 70% drawdowns in this thing between now and then on several occasions, I think. So it's something you need to be very, very careful of. I think you need to understand that unless you are in a very small group of people who really understand this thing, you are intellectually outgunned when you're going into the Bitcoin world, and massively so. So it's a very dangerous place to go and play if you really don't know what you're doing and you just think, I'll take a flyer on Bitcoin. You might get lucky and make some money, but you could lose, half to 80% of your investment overnight. It's quite possible. So people should be very careful. The one other thing I'd say in regards to what Ronni was talking about, I think I understand the kind of tension between Bitcoiners and gold guys. I think if you're a Bitcoiner, if gold's out of the equation, Bitcoin is the solution, right? Gold is the only real comparable solution to Bitcoin in terms of what it offers people looking to escape the fiat financial system. In the term of gold bugs, I think everyone's just so sick and tired and saying, why haven't we had a point in time where gold's done what Bitcoin's doing now?
Yeah.
They've been waiting so long for it. But that isn't what gold's designed to do. Gold is not designed to make you rich. It's designed to keep you rich. And that's a distinction that people really need to understand. If you're looking to speculate to get rich, gold is not the vehicle to do it. If you have wealth and you're looking to preserve it, gold is absolutely the right vehicle for that. So just know what you're looking to try and achieve before you get involved in either cryptocurrencies or gold.
May I just add one thing, Grant? Our mutual friend Ben Hunt always talks about narratives, and I think it's really important how the whole Bitcoin story developed, because at the very beginning, those were those cyber punks basically trying to to overtake the monetary system, to recreate the system, to circumvent banks, and to basically take away the power from the central banks. And then at one point, perhaps I don't know, marketing guys at the central bank said, well, we have to add a different narrative, and the new narrative was, well, this is something for the dark web, and only terrorists use Bitcoin and so on, and this is very, very powerful. So if we talk to large institutions, to banks that are very bureaucratic, and the guys sitting on top, they're mostly older people, it is exactly this narrative that they have in mind. This is something, this is kind of shady, and it's only for illegal transactions and so on. But now it seems the new narrative in the market is, well, this is something to get rich very, very quick, because Bitcoin will go to 100,000 or whatever, and I try to squeeze out as much as possible and lever it and whatever. And this bugs me quite a lot, because I think at the very beginning it was really something about, let's define money. Let's talk about the advantages and disadvantages of our monetary system, why gold is better than the US dollar, why Bitcoin might be better than other currencies. It was about this competition in our monetary system. And it bugs me a bit that this whole discussion that is so extremely important, that this is basically lost in this move.
Yes, well, you're right. It's always Bitcoin versus gold, which is not really the point. I mean, it's also as you pointed out, it's generational, isn't it? Younger generations prefer Bitcoin because it's more exciting and it moves faster and it's more volatile. Whilst the older generation that buys gold for wealth preservation purposes, they don't even think about Bitcoin, of course. And I think that's the big difference between the two, as we see it. And we, of course, are wealth preservation experts. And from our point of view, Bitcoin is an investment, could be a very exciting investment. Mm-hmm. You could make a lot of money, but as you both have pointed out, especially Grant, you could lose it all also. That's the danger with Bitcoin, and therefore you shouldn't put all your money into Bitcoin. You cannot compare a currency that is 10 years old or a bit more than 10 years or an instrument, if you want, like Bitcoin, with the only money that has survived in history. And the other thing is, we say about gold, gold is a wealth preservation asset. It must, first of all, it mustn't be dependent on a system which needs electricity or internet or computers. Real money shouldn't be in a form that you need all of those technical things for it to operate. And also, it shouldn't be hackable. And Bitcoin is clearly hackable. Sure, you can take it offline and cold store it and all of that, but every time you want to transact, it is hackable. And think about the Chinese quantum computers now with was it 100 trillion times faster than existing computers. They can break into anything, of course, in the future, and they will do. I'm sure China will do. And then, and of course, and also with that computer, they can crack the code. There's no question about it. So that's a risk of a digital system as a wealth preservation asset. As an investment asset, you take the risk of that. You don't care. But for the part of your money that you actually want to preserve for your future, then that is not advisable in my view. And that asset should not either be just traded online. I think that if you have a wealth preservation asset, it should be offline. That's the whole purpose. Mm-hmm. Nobody can touch it. It's yours, only yours, and it's independent. As our friend Simon Mikhailovich is saying, gold is independent, scarce, and permanent. The only thing that gold has in common with Bitcoin is that it's scarce. But otherwise, Bitcoin is not independent, and nor is it permanent, but gold is. And that's why, there's no way, in my view, that gold will be replaced by Bitcoin in the near-term future. You cannot replace 10-year digital or digital asset with or gold with a 10-year digital asset. That's just not possible in my view. Let's come back in 100 or 1,000 years, and then we can discuss it. If actually a Bitcoin, or there'll be so many different digital currencies in the meantime, won't there? But there's only been one gold. Okay, let's talk about the final point now. A lot of people have asked about what's going to happen in 2021. And of course, we all know that forecasting is a mug's game. You can never be right. But what you can say is that you have to look at the risks, because that's what really investment is all about: understanding the risk, understanding the downside. Grant, how do you see the risks for 2021, and how do you see the world actually evolving?
Look, I think the risks are significant. They remain elevated. If you think about it, the only part of our lives which seems to belie the idea that risk is elevated is the stock market, is asset prices. Everywhere else you look, the risks are clear. I mean, everybody knows people who've lost jobs. Everyone knows people who've had to close businesses down. Everybody knows people who have either gotten sick or sadly in many cases died. These are very real risks. And so when we inhabit the financial world and we sit here looking at Bitcoin doing what it's doing, or the stock market at all-time highs, or junk bond yields at all-time lows, we are seeing extraordinary things that have nothing to do with the real risk that surrounds either financial markets or the global economy. Everything is predicated upon the fact that easy monetary policy and stimulus works, B, that no matter what happens, there will be more of it, and C, that it will continue to work. That's essentially it. That's the whole investment case for risk assets right now. And so far, it's been a great bet to take. Back in March, when people were scared witless about what was going on, if you'd have had the guts to step in back in March, you've had one of the best years of your entire career, if not a generation, frankly. But if you think about that for a second, when you look at the damage done to the economy, of course, it makes no sense. I was back in London in the summer, staying near Piccadilly Circus, and there was nobody there. The shops that were open were empty. The restaurants that were open were empty. There was nobody around. And yes, that's a tourist part of the capital and not where people are working. But when you walk around the middle of situations like this, you realize that this cannot work. It doesn't work this way, that businesses are open and empty. Either you have to lay off all the staff because there's no business, or you close the restaurant down, in which case who's going to come and shop, who's going to come and eat? So there is a very real disconnect between asset prices and the economy. And my fear is that people ignore the economy and focus on the risk assets, because that's a much more pleasant thing to focus on. If you have stocks and shares, you own bond portfolios, you've had a great time. And it's very difficult when you're having a great time like that and seeing the value of your investments increase so dramatically, to take money off the table and think, well, against this backdrop. So I think there's a very real risk here of this bubble bursting in the near term. It's something we've been warning about for a while, all three of us, but not with any sense of immediacy, just trying to make people aware that whatever you do, don't just invest blindly thinking there aren't dangers out there. But what we're seeing now, particularly with the likes of the Bitcoin frenzy, what we're seeing with the likes of Tesla going into the S&P next week, we're seeing a series of crescendos that, when you put them together, suggest that something is happening here, that you tend to get at those extreme blow off tops. So I think there's very real risk here in risk asset prices as we turn the corner into 2021. There is definitely hope. The vaccine gives everybody hope. Ronnie and I were talking about this off camera before we came on. about the potential for people to really kind of push the boat out once the all clear is sounded. So I'll let him talk about that. And so there are definitely positives, but given where we are and where we've come from, I think assuming that the positives will do what we've seen again is a very risky bet to take.
You know, I'm watching actually now, probably you have seen it. I'm watching the last SARS, but on Netflix, you know, which was the end of the Russian Empire and the fall of the Tsars, and led to the Russian Revolution. And, you know, we're getting to that point now. I mean, the extremes between the rich and the poor have never been greater. And of course, what's happened just in this year have exacerbated these differences. So the rich and the rich and the big Bezos of this world, etc., they're getting, you know, exponentially rich now because of the printed money, because they get all of that, plus they get all of their, they have the right business also. They're clever. So I mean, they sell their wares in Amazon. And then the poor, you know, we have the other side. Nobody's, whilst the stock market is booming and the rich are getting a lot richer, you know, you have normal people. There are so many people who are losing their jobs, who are either redundant or small businesses. You know, they're going out of business all the time, and everybody in the leisure industry, travel industry, etc. You know, they're also losing their jobs. It is a catastrophe out there, but you know, the world hasn't seen that yet, or the investment world hasn't realized that yet. And you're right, Grant. But that, I think, that realization is likely to come next year.
I think they've realized it. I absolutely think they realize it. But again, they don't care because they're not focused on the reality. Their job, frankly, is to make a return. And so I think they realize this, and they're all waiting for the shoe to drop. But in the meantime, there is infinite liquidity that will be poured.
They've got to spend the printed money. That's what you're saying. Yeah, they have to spend the printed money, and that's what they're doing.
Not that they don't realize it. It's not they don't realize it. They absolutely realize it. But they know what their job is there to do, and they're going to do it.
What's your fear about next year then? What's your fear about next year, and Anja, how do you see the risks?
Well, I think Chris Cole said that in an interview. He said that capitalism actually died in April, and I agree because it seems that free market forces are not existing anymore, and there is no market anymore. There's only interventions, and I think, you know, the market participants have been conditioned like Pavlovian dogs. They need more and more stimulus, and this year we have seen the perfect combination of this thesis. And I don't expect, you know, the new administration in the United States to be more free market, to be more capitalistic. It will be more interventionism. It will be, more of the same, actually. So that makes me, of course, very much concerned, and therefore the markets are basically only about discounting or anticipating what central bankers will do next. And I retweeted this tweet from Mrs. Lagarde, a picture of hers together with Janet Yellen, and she's so super happy on her nomination as US Treasury Secretary. And if you follow, for example, Mrs. Lagarde, she's writing about, well, the ECB has to take care of climate change and those things. And, you know, it's getting more and more absurd for me, because, you know, there's only one mandate that the ECB has, and this is price stability. They don't have to talk about climate change and actually solve the climate crisis. So things are getting really strange. And just one thing, I saw a pretty ridiculous or pretty fun new ETF. This is called the Vegan Climate ETF. And actually the biggest positions in this Vegan Climate ETF are Microsoft, Apple, Tesla, and I think Google, and I think it's just quite telling, and of course it's been a huge success because everybody wants to buy those things. But what I want to say is, you know, when it comes to the economy itself, I'm not that pessimistic, because I think that first of all, with the vaccine, I mean, over here, most people say, well, I don't want to be first with the vaccination. You go first, because nobody knows about the long-term consequences, and I can totally understand it. But what will governments do? They will try to nudge you to take the vaccine. And I think that actually with rising confidence, with more visibility coming from consumers, coming from businesses, I think that velocity will actually pick up next year big time, and we're already seeing that velocity has stabilized and is turning up. So this basically confirms my inflation thesis, and we should not forget we've got the base effects kicking in. So actually we will end up with 3, 4, 5% inflation in spring of next year. And therefore, I think, you know, when it comes to, actually, we haven't talked about gold too much yet, but I think all our listeners, they know already that we've got quite an affinity for gold. But I think it's going to be a tremendous year for gold. It's going to be a tremendous year for silver going forward. I can tell you that this year was the first year when I really recognized that it is becoming a part of institutional strategic allocations again, and therefore I really expect more institutional demand for gold. We all know that you know, we won't see rising rates in the next couple of years. You know, the debt burdens got bigger and bigger. They are higher than the Matterhorn now, probably. So chances for rising nominal rates are definitely not existent. So we know that we will have negative real rates for the next couple of years, which is of course stimulating this everything bubble. Everything is rising, and the correlations in markets are extremely high, and this is a big concern. And I think, you know, that the last couple of weeks we've seen a very, very weak US dollar. And I fear that once the US dollar makes at least a bounce to the upside, I think that many market participants will really get cold feet and become nervous, because as we all know, those sentiment indicators at the moment are basically priced to perfection. They're super bullish, super optimistic. So I think we should expect much more volatility in the first and second quarter. But as I've said, it is probably the beginning of the big crack-up boom. So from my point of view, we're definitely in the right business at the moment.
Well, I hope you're right, Ronni, with your optimism, but I will have to disagree a little bit. And of course, if two people agree, one is superfluous. So I don't know which one of us would be superfluous. But, you know, we have to remember that this crisis didn't start with COVID. It didn't start in February 2020. It started in August, September. It started long ago. But the acute crisis started in September 2019. And this is problems in the financial system due to the debt, as we've been talking about, and that they were acute problems, and those problems are still there, and they're getting a lot worse because all the printed money, you know, we're trying again to solve a debt problem but with more debt, and that's not going to work. So in my view, you know, we are going to see, and you show that in your last report, we're going to see more money printed, which has less and less value. Mm-hmm. Therefore, you mean more and more dollars per dollar of GDP, or per dollar or per GDP of euro, etc. So, you know, and that will continue in my view, and the banking system will be under tremendous pressure, because you're going to have a lot of businesses also coming under pressure here. So I am not as optimistic as you are on rates. I think that, you know, everybody's so complacent, rates are not going to go up, and I think they are, because I see a debt problem, as we talked about before. I see, you know, the debt, that debt has zero value in my view. It's not going to be repaid. Now, with zero interest rates, it's not a problem to finance short term. But if we get pressure, I think actually the dollar has started a downtrend, and you know, the more pressure you get on the dollar, you know, then the interest rates will come under pressure, and all currencies will come under pressure, of course. But I think interest rates at some point in the next year or so start moving up, and real rates maybe will not be high, but we will have negative real rates still. But nevertheless, and I see, if I look at stock markets, we could have a crack up boom for in the next few weeks or even in a little bit longer. I've said that, but thereafter, I see a secular bear market starting in stocks, and that is a long-term crash, basically starting sometimes in probably 2021, and it could be earlier also. So I see a lot of problems in the financial system, and I think the whole world is too complacent about we're not going to see higher rates. Everything is going to be financed at zero rates. It's going to be no problem. Whilst actually the disconnect, as Grant was talking about, is going to grow bigger next year because none of the problems are going to be resolved. So I'm much more pessimistic than you are about the world. And I think, of course, gold will, as you said, gold will react to this dramatically. And gold is in a very strong uptrend now. Even the last little correction is finished, in my view, and we are going to see gold prices, which are going to be a lot higher. But it's not gold going up. We know that it's not gold going up. It's actually, somebody asked when will gold stop going up and when should we sell it? It's not. Ask instead yourself, when is paper money going to stop falling? It's going to stop falling at zero. It always has in history. And more and more I write about history repeating itself. Wherever I see things is always repeating itself. Currencies are going to go to zero. How long it will take, we don't know. Grant, you take issue with this?
Oh, look, I think you're right, Egon. But people need to be when we talk about catastrophic events, people tend to think it's a one-off thing, and they want to know the day it's going to happen. And that's problematic, because obviously none of us know the future, but we all know the past. Some of us choose to read it and study it and understand it, and others don't. So that's the best guide we have. And all you can do is look to the past, look at similar periods. I don't think we've ever seen anything quite like this before, but there are plenty of clues in history. And you can understand the dynamics at play here, and the madness of crowds, and you understand how human nature works. And so you can get a sense of what's very, very likely to happen here, but none of us ever know when. We don't know when this is going to happen. We don't know what the trigger will be, although it's likely to be something that comes out of left field and surprises people, just like COVID did. And don't forget, your point was well made, Egon, that these problems all existed prior to COVID. What we saw in stock markets in February and early March was triggered by COVID. But COVID came out of nowhere, right? But it wasn't something we couldn't see coming. There have been pandemics before, but this surprise triggered a huge sell-off. And if it hadn't been for 13 plus and counting trillions of dollars thrown at the problem, we would now be in a very dangerous bear market. So just for everybody watching this, just be aware that what we're talking about here is a group of situations. We're talking about trying to understand all the dynamics at play and understand, most importantly, what the risks are, because this has been an extraordinary year. If you'd been asleep or had no Wi-Fi through February and March, and you've just come back into contact now, you'd have no idea what had happened. And obviously, the single biggest economic event of our lifetimes has happened. So something's not right. So you need to understand the risk. Don't just assume that because markets are at all-time highs, everything's fine. It's not. But not one of the three of us can give you a date when you need to sell everything the day before. It just doesn't work that way, I'm afraid.
I'm glad you said that, because that's what really we are all about here, preserving wealth and taking care of risk. So it doesn't matter if stocks go down tomorrow or the day after or in a year's time, or if bond markets crash and currencies crash. What matters is, as you say, that from our point of view, what we're trying to help a few people with is to help people to protect themselves. And this is why we all go back to gold, because gold has throughout history been the best form of protection. And whether these events happen in the short term or it takes a lot longer, it's irrelevant. The risk is at a level where we've never seen it in history before. and therefore, you buy your insurance and then you sleep calmly. Ronnie,
I just wanted to say, because everybody's talking about the Great Reset now, and it reminds me of New Year's in the year 2000. Everybody was, I was 20 years back then, and we thought, okay, this is gonna be the greatest party ever, and everybody prepared, and nobody knew where to celebrate, and it was like a really big topic. And then you had the countdown, and then 0. Well, okay, big fireworks, it's year 2000, but what now? So and it reminds me a bit, I think we shouldn't wait for this big reset. I think it will be a road of financial repression, and we're already seeing enormous amounts of financial repression. We will see more capital controls. We'll see much more central bank intervention. There's, lots of talk from politicians now with a temporary wealth tax, because of solidarity, you have to pay higher taxes. Yeah. I think, we shouldn't rule out that it's not going to be one point in time, but just a long time, many years, even decades, a bit like Russell Napier always describes the financial repression after the world wars. So from my point of view, of course, we are seeing lots of demand from really high net worth individuals that say, well, I don't want to store my gold in only one country. I want to diversify. We're seeing great talents moving into other countries. So I think it's we clearly see that this capital consumption in the Western world is happening, and therefore, perhaps I sounded a bit optimistic. It was more tactically, I would say, but from a systemic point of view, because it's a systemic problem that we are in, that nobody cares about our monetary system, and nobody really wants to talk about the root cause of the mess that we're currently in, that obviously started in 1971. Therefore, I think at some point there will be, let's say, a reallocation of our monetary system, as the diplomatic Swiss would say. And I think gold will play a major role, but we shouldn't rule out that it's going to be a long period.
Yeah, and it could be violent also.
Yes.
We could have one reset, 2 resets, 3 resets, and my big concern, and I think it's not unlikely that they might try some orderly resets, but there's a high risk of a disorderly reset. So when everything goes out of control, I could easily, that's what happens when debt implodes. Grant, do you want to say some final wise words here to the world?
Well, I don't know how wise they'll be. Look, I think most of the people watching this have come here because they have an interest in precious metals. And I think that is probably the first step that people need to take, is actually understanding what precious metals can do for you in periods like the one where we've been going through. I mean, the precious metals have been in a bull market for 20 years now, realistically speaking. There's been a period in the middle after 2011 when they had a big correction. But if you'd bought gold to protect yourself from the issues that we face today in terms of currency debasement in 1999, 2000, when it became obvious, I think, that that's what the Fed were going to do, they were going to lower rates and print money, then you're up 5, 6, 6, the S&P over that time. So gold has done an extraordinary job just sitting there protecting your wealth. So
that's of course when our company started. So yeah, absolutely.
Right. But so understand what you're looking to achieve. If you're looking to speculate, this is a fantastic market to speculate in because there are extraordinary things happening. But if you're a speculator, just know that you can lose an awful lot of money. If you're looking to preserve wealth because you're worried about the potential outcome of the economic disruption that we've been through this year, then that's a completely different approach. But I think the one thing everybody needs to ask themselves is to have this inflation deflation debate, because if we are moving, as I suspect we are, into an inflationary environment, then very few portfolios in the world are constructed to effectively deal with that problem, because it's not one we've had to face except for 10 years out of the last 70 or 80.
Yeah, no, well said. Right. I think we are just now under the hour, and I think it's time to wind up. I think it's been an extremely useful conversation, and hopefully our audience have found the same. And remember, at the end of the day, especially in these times, the most important thing is to help your friends, help your family, because there's going to be a lot of people who will suffer in the next few years. And the happiness is really helping others and giving love to others rather than helping yourself to bigger wealth. That some people are playing that game now, but really, and especially now at the time for Christmas, also think about your family, think about your friends, because a lot of people are suffering. So I thank, first of all, my fellow panelists and advisors, Grant and Ronni. And I thank the audience for being with us this whole time. I think most people have stayed in, which is very nice to see for the whole time. And we hope to see you all next year sometime, maybe in January, or early February. We'll see what happens. But in the meantime, thank you, Grant. Thank you, Ronni.
Thanks, guys. Great to see you. Merry Christmas and Happy New Year to everybody. Thanks for joining.
Merry Christmas.
Thank you.
All the best.
Yeah.
Take care.
All the best to everyone. Thank you so much. Thank you. Bye-bye.